Hello and welcome to the Truth About Real Estate Investing show. My name is Erwin Cito, where we discuss many stories and lessons around real estate investing so together we grow as real estate business owners towards our goals of financial peace, avoid landmines, scams, and con artists. As our regular listeners know, it is not all sunshine and rainbows out there. The truth about real estate is these are tumultuous times. Many novices who were over leveraged, too aggressive, investing with their ego, instead of what we here teach our clients, a pragmatic, measured approach, incorporating best practices we've developed in my nearly 20-year career as an investor. We've transacted on over $400 million in real estate, and that's almost entirely investment properties, that positive cash flow. It's actually translated into, among our clients, we have about 45 self-made millionaire clients who've made that million or more in income properties. So I've excluded their homes. Here at iWin Real Estate, we're like financial advisors, but real estate investing focused. And I actually have clients who've made, again, not only $1 million or more dollars, but they've done so conservatively, systematically, with cash flow, and honestly, it's quite boring. One of my millionaire clients reported back to me after attending one of these newer coaching groups, their meetup, where they pitched, where the pitch was to get rich quick by buying multiple properties in a short period of time with expensive private money and flip and burr strategies and coaching, very expensive coaching, easily more than in the 5 figures a year. Unfortunately, it's these same groups that are producing bankrupt clients. These groups are great at making money for themselves. Even if you have a handful of bankrupt coaching clients, I think that's way too many, especially when I think it's extremely avoidable. As an insider to the investor community, I'm connected with some of these students, actually many of these students, and coaches and former coaches, and we'll be hosting some of them on this podcast over the next few months. So do keep in mind, though, those who did play conservative, those who've been, having cash on the sidelines or saving up for these times, folks who have great credit will be taking advantage of the increased number of failed speculators, these power of sales and distressed sellers hitting the market, the spring market. Honestly, it's our clients who have been taking advantage of this market so far. For anyone who came on our tour this past weekend, you saw the properties that our clients picked up for great deals, and we'll continue to do so. We'll actually continue to build intergenerational wealth, unlike these other gurus that are advertising while they undergo rebranding. One of these companies recently just sold to another guru. Not bad. I'm not saying all gurus are bad, but we're seeing some consolidation shakeup in our community, especially among the coaching companies. We're seeing changes of leadership, and straight up, I've been hearing stories that some of these groups, the customers are demanding refunds, $10,000, $30,000 on whatever they paid, because honestly, they've gone broke from the teachings of those courses and coaching. So anyone who wants to continue along in this journey to learn the truth about real estate investing, specifically how to actually be successful, Cherry and I will be co-hosting an investors meetup in Whitby, Ontario, followed by an educational tour. No pressure as always. It's a group, comfortable, no pressure as always. Tour of income properties and a mastermind lunch, all on Saturday, March 25th. This will be our first time ever hosting an iWin meeting in the Durham region, and if this goes well, we'll make it a more regular occurrence. The cost is nominal. All profits go to our charity, the Hamilton Basket Brigade, to outfit poor school children with warm winter wear. Cherry will be presenting on the absolute must-knows for the tax season of 2023. Cherry and her accounting team at Real Estate Tax Tips has been working away with their 500-plus real estate clients, and they know what all the frequently asked questions are and the lesson and the teachings that their clients must know about. You don't want to miss this, as there honestly is a lot of confusion around the new tax rules from our lovely Trudeau government. And yeah, again, you don't want to miss it. My team and I will be giving an economic market update, followed by how to best profit from these opportunities from the Oshawa to Kingston, Ontario markets. With interest rates at or near peak and a flood of power sales coming on the market this spring, this could very well be the bottom of the market. Again, my crystal ball is no better than anybody else's. But again, we'll go over economics and market update on Saturday 25th, March 25th. So yeah, no demand. So it's no surprise for me that we're already seeing the demand is greatest in the sweet spot that we invest in specifically. And we've always done that since, honestly, since I started in 2005. So save the date, Saturday, March 25th. It is my birthday weekend, but no rest for the wicked. And honestly, there's nothing I enjoy better than helping hardworking Canadians create financial stability and peace in their lives. On to this week's show. I had no idea how many new tax rules we investors have to deal with this year. I thankfully, one of the greatest wealth hacks I can share from my experience is to marry your accountant. I thankfully did. The underused housing tax is especially concerning as it's extremely new. The forms only became recently available, and I've spoken to many pros, real estate investment pros out there who don't understand it either. I understand it now thanks to doing this interview. What's worse is the penalty is $5,000 to $10,000 for not filing. And this specific underused housing tax filing applies to many of us in the investor community. And again, understanding is not clear. And even though many of us are excluded owners, I am an excluded owner, thus having no liability, I still have to file. And if I have to file, I imagine there's many of you also who out there who have to file. I'm not an accountant though. Please speak to your own accountant. I did happen to invite my lovely wife, Cherry Chan, CPA, CA, who happens to be the most in-demand real estate accountant speaker out there, to share some of the top tax changes we face in 2023. So Cherry does break down some of these tax tips on her YouTube channel as well in more detail. So make sure to subscribe to her channel along with the other, honestly, 10,000 YouTube subscribers. YouTube, when you go on YouTube, just search real estate tax tips. It's actually one word, real estate tax tips on YouTube. In case you're curious, yes, Cherry is still accepting new clients. That is honestly the number one question I get: is Cherry accepting new clients? Yes, they are accepting new clients, but not for 2022's filings, right? Because they're already full swing into tax season. They're already beyond full swing into tax season. So I'm not sure how much longer that is that they're accepting new clients. admin@cccpa.ca is the email address for your inquiries should you want to work with Cherry and her team. Again, it's admin@cccpa.ca. In case you're wondering, the domain is an acronym for Cherry Chan Chartered Professional Accountant.ca. Please enjoy the show. Hi, Cherry. What's keeping you busy these days?
Everything. I think the biggest thing for me is the Underused Housing Tax Act, which I think is shattering the entire accounting world, or at least in my business, because I routinely work with people who are required, based on this legislation, who are required to do the filing. And they just released the filing form. And that's why we're like crazily scrambling to put the system together, put the human resources together, put everything together to make it work.
Yeah, I remember seeing the look on my client's face, Justin, who is an accountant as well, and he had no idea when you explained this to him what this was.
Yeah, it is a complicated thing. Although the intent wasn't to have any requirement for Canadian resident or Canadian citizen, Canadian permanent resident and Canadian citizen to do the filing, because they would be most likely exempted from paying the tax. But somehow the way that the legislation is written, now a lot of Canadians and a lot of Canadian corporations would be required to file the return.
So anyone that owns any property?
No, so it's only applicable to residential properties that are triplex and under. Yeah. And if you own a commercial property that has 3 units and under, you may also be dinged on it, depending on the use of your residential portion in comparison to the commercial portion. So those would be the affected properties owner. So like single family home condos, but only residential condos, not industrial condos or commercial condos. Yeah,
like this one that we're in.
Yeah, those would be exempted. But it's residential condos, semi-detached house, duplex, triplex, row houses, so townhouses.
So even a vanilla homeowner?
What's a vanilla homeowner?
The majority of Canadians that are just regular homeowners that don't own any investment property?
maybe not. So depending on if they are an affected owner or not.
What's an affected owner?
So an affected owner includes a Canadian corporation, private corporation, partnership. To a certain extent, it may also include joint venture relationship. So for example, if you have elderly parents and your elderly parents, to help them taking care of the whole house, the elderly parents say, hey, I need to add your name to the title of my house because it helps me to handle all the affairs of the house. But you don't truly own that property. You're just being added for the purpose of helping out. The true owner is still the parents. With this type of arrangement, you're essentially acting as a trustee to be on title in trust for your parents. And under that scenario, because you're a trustee, you are now required to file a return.
Okay, so I don't think that's a very common case.
It is common because a lot of elderly Canadians would have their kids on their primary residence house to help them.
Okay, that's a whole other ball of wax that I don't want to get into.
I know it doesn't quite affect a lot of.
Because most people think automatically just do a power of attorney instead, but there's benefits of both, and again, it's not a conversation. I don't think we need to get into that today.
Well, but it's applicable as of December 31st, 2022. So if your name is on title December 31st, then you have a filing obligation.
So what if, like Adam, who is on title for his home,
yes,
does he have to file?
Well, if he is the sole owner and sole beneficial owner of the home, he's not acting as a trustee, then he doesn't have to file. But for average real estate investors that you and I deal with, they do a lot of joint venture. If you're in a joint venture relationship, you are the one that's on title, and you have a joint venture partner that's off title, then you're all of a sudden a trustee, then you would need to do the filing.
Okay, so only trustees.
Well, that's what they say. Right now, the trustee has to do the file, whoever that's on the legal system. But there is a second part that talks about, the legislation has a second part that talked about who are the owner. If you are the trustee, you're owning the property on title, you're the one that's on title, and you're owning it in trust for the corporation. The corporation is also the owner. So if you could be identified as an owner because you're a Canadian corporation that I mentioned which would be an affected owner, the corporation would still have the filing obligation.
Right.
So the corporation has it, and if you are the one on title, the individual would also has the filing obligation because the individual is acting as a trustee.
Okay, so trustees and corporations. Is that
Yeah.
where we draw the line in the sand?
And partnership.
And partnership.
Yeah. And then non-Canadian as well, but then we don't have a lot of non-Canadians listening to the show.
Not many of our clients are non-Canadians.
Yeah.
Okay, so non-Canadians, trustees, corporations,
Partners in partnerships.
Partners for investment purposes, or even like wedded partners.
So they specify as partners in the partnership. I always on my YouTube video, I actually mentioned the house that we kind of own together. The single family townhouse that I've always owned. It was my primary residence in the past. Throughout the years, I've always reported the income and expenses on my own personal tax return. But throughout the years, we refinanced that property a couple of times, and that property, and through that refinancing process, the bank require your name to be added to title. You're now a trustee. I've always reported that 100% income and expenses. There's no change from a tax perspective, but you're added for the purpose of mortgage. You're really owning it in trust for me. Mm-hmm. So all of a sudden you have that filing obligation because you're on title in trust for me. Now, vice versa, right? There are a lot of couples that one spouse, the high income spouse, is on title, but then the reporting is done by the husband and wife, both spouses together. Then all of a sudden, whoever that's on title is now a trustee. I don't know if that makes sense. Now then you understand the magnitude of how crazy this UHT, the Underused Housing Tax Act, implies.
I think we're blowing up every accountant's phone lines right now.
Not really. A lot of them don't know. But the reality...
Oh, no. Like, people are listening. They're gonna go call and ask their accountant what to do.
Yeah, absolutely. But
Because they're all investors, so likely almost all of them have to... It sounds like pretty much anyone who owns an investment property will have to file.
Not really. Now, let's use an example. If you and I are in a joint venture together, for one of our student rentals, we're in a joint venture relationship together. Both of our names are on title, and we are joint venture. We're not partnership. If we call ourselves partnership, then you have the filing obligation. But if you call yourself a joint venture and your intention is joint venture, and you demonstrate evidence that you're operating as a joint venture, or you have a joint venture agreement signed, then there is no filing obligation, because I'm a Canadian citizen, you're a Canadian citizen. You own 50%, I own 50%.
What is the objective of this new form?
So the objective, funny, because this is totally, what we just discussed is totally not consistent with the objective. The whole objective is to prevent foreigners to own Canadian residents and leaving it vacant or operating it as Airbnb.
Oh, they're on the hunt.
Yes.
This is the federal government.
This is federal government. It affects Canadian-wide.
Okay. Wow. So instead of asking anyone who's foreign owning and anyone who's operating Airbnb to identify themselves, they're asking everyone who's not.
It's the similar situation with like the Toronto vacant home tax, right? Like there could be a very small percentage of people who are leaving their Toronto home vacant.
Yeah.
But they're forcing everyone in the city of Toronto to report to the city of Toronto website that are you renting it out to someone, and on a long-term basis. And this happens in city of Toronto, happened in city of Ottawa, has already been implemented for a long time in Vancouver, and then the government in British Columbia also sent out another letter for them to do the filing. And this is on top of all of these, completely different.
I'm sure the CRA employees love this idea.
Yeah, it's crazy. I can't even tell you how crazy it is, because the form was literally released middle of January, and the filing deadline is April 30th. And throughout the last 2 weeks, they've released 13 technical interpretations. Last 2 weeks. And what date's today? February 17th?
What percentage of your clientele do you think are affected?
I think all of them are affected. A lot of them.
100% of
I wouldn't say
plus?
I don't.
Or close to?
I don't think it's 100% of it, but
95?
substantial amount would be affected.
80%?
Well,
even if it's 80%, that's a lot.
Sometimes it's in an implied relationship, right? Like we wouldn't know if it's a husband who's on title, and then the husband and wife are both equally reporting the income and expenses. That is really hard to identify, right?
Right.
That's
if you're not doing their personal taxes, yeah.
If we do their personal taxes, even then, like it's always been reported this way. We don't necessarily go back to the original purchase agreement every single time, right? How would you know?
So are your billings gonna go up?
Well, our liability is going to go up. So for non-compliance, for individuals who doesn't file and who's required to file, the penalty is $5,000. For corporations who are required to file and do not file, the penalty is $10,000. And if you don't file on time, they have the right to take away the exemption from the tax. And the tax amount is 1% of the fair market value of your property.
That sounds pretty serious.
Oh, it is serious, which is why it leaves the entire accounting world scratching our head. The whole legislation is about 89 pages long.
Right. And you've spoken to your friends in the industry as well. Like, are they just as concerned as I am?
No, I am concerned. I think because it impacts our accounting practice so much, almost everyone. I wouldn't say almost everyone. I think 80-90% of them are affected. And we're trying to figure out how to raise this to our clients effectively and efficiently, because we're also in the middle of tax season. Personal tax return deadline is also April 30th. This underused housing tax form also has to be filed by April 30th, and they just released the information. So we're like scrambling to get this thing done and get the message across. The most common misconception that our clients have, and they wouldn't even open my email because it says Underused Housing Tax Act, and in their mind they said, hey, my houses are all rented, they're not underused, and therefore I don't need to know about this. But it's the opposite. You just have the filing obligation even though you're exempted from paying the tax. And then the second misconception is that, hey, like I already did the City of Toronto or City of Ottawa or Vancouver reporting. This is the same thing, so it doesn't apply to me. But that's not true.
They don't talk to each other. Those governments don't talk to each other.
Yeah, those people are actually different type of filing. This Underused Housing Tax Act is federal, all across Canada.
Does the government just want to know who has Airbnbs?
It's
not trying to track it.
I don't think
it
is
trying to limit them.
I don't think it's Airbnb. It's really targeting foreigners.
Fascinating.
But then if they rent out their property on a long-term basis, then they would be exempted from the tax. They just need to do the filing as well. But if currently the way that we've seen it is that if the foreigner own the property and operate it as an Airbnb short-term rental, they will have to pay the tax. Right. Or leave it vacant, they would have to pay the tax.
How much is the tax?
1% of the fair market value. That's annual, every single year.
That's not cheap. How many people know about this?
I don't know.
Probably nobody.
I think most accountants would, like, I don't know if most accountants
Justin
would
didn't know.
So
poor Justin being thrown under the bus.
I know about it because we are in this particular business. We have to know it. It is a huge thing. Well, the truth is, it was announced in budget 2018. It's effective January 1st, 2022 for properties that you own as at December 31st. If you don't own it as of at December 31st, you don't have any filing obligation. But it's just the form hasn't been released until middle of January of this year. Yeah. So that's where the scrambling come in.
Great.
Yeah.
More work.
Yeah.
Doesn't seem fair.
No.
That they released the form in the middle of tax season.
Yeah, exactly. And the form is not easy to understand.
People are likely to make mistakes.
Yeah, so you're required to try your best to fill out the form as well. If not, then they could also impose the same penalty.
Yeah, this is great.
Yeah.
Instead of the CRA going after all the government stimulus money that was given away without any auditing.
Oh, they are going after those too. So they're going after the wage subsidies. They're going after the not so much the CPA loan, but the wage subsidy, the SERP as well. They're going after those.
Do you know much about it? As in, like, what are the penalties? What are they looking for? Everyone has to report it. First of all, everyone has to report it, right? All the businesses have to report the wage subsidy, and individuals have to report SERP as income?
SERP has to be reported as income. Wage subsidy has to be reported as income. I don't personally have any experience working with that wage subsidy audit. Our exposure is relatively limited to it. Our clientele don't have a lot of those. Mm-hmm. So we're not really exposed to it, so could not really tell you much. Our experience with the insurance company that we work with, who provides insurance to accounting firms, clients, they're telling us a lot of their other accounting firms are like scratching their head, pulling hair out on going through these audits.
Lovely.
Mm-hmm. They're going after it.
They should. I've already detailed how the word is questionable the judgment was to hand out so much money, and when a lot of it's going to be lost. But anyways, what else? All right. Anything else we need to cover? Talk about on this vacant home tax, whatever it's called?
No, it's underused housing tax.
Underused.
It's not vacant home tax. you get people confused. Now, one thing that I do want to mention that people have a lot of confusion. Just because you don't have to pay the tax doesn't mean that you have no filing obligation. The penalty that I mentioned, the $5,000 for individual, $10,000 for corporation, they are imposed on non-filing. So even if you have no tax to pay, so using us as an example, our house,
everything's legit. We're all long-term on everything.
well, we're Canadian, so you're exempted anyway. So you own it in trust for me, our Toronto townhouse, we do the filing, there is no tax to be paid. It's just that you have to do the filing.
Good Lord.
That's it. Like, you don't, like, there's nothing to be paid because you're Canadian. You're owning it in trust for another Canadian. So there's no tax. We're exempted. It's just that, unfortunately, we still have to do the filing. So some people, some of our clients also have joint venture partners, and their joint venture partner's controller is telling our client, oh, you don't have to file it. Look at the screenshot, you're exempted. Well, the reality is you're exempted doesn't mean that you don't have the filing obligation.
Yeah.
Oh, no. You have the filing obligation. You are exempted. You just have the filing obligation.
Fascinating.
Yeah.
Because all my clients will be exempt. But there's all this admin work that has to be done.
Exactly. For no reason.
For no reason. Oh yeah, none of them are part of the problem.
Because if you think about it, the objective of the legislation is to prevent foreigners from leaving their house vacant or their residential property vacant, and thus reduce the number of properties available for local Canadians to live. But now the whole legislation is written in a completely different direction that almost everyone in our practice would be affected.
All right, whose bill is this? You said 2018, so I think that was still Liberals.
I think we're still Liberals, so.
So we know I just want to know so I know where to direct my anger. All right, that was a mouthful. Apologies to the listeners we've scared and all the accountants whose phones are burning up right now.
Yeah, tell us about it.
All right, what's the number 2 thing people need to know about taxes in 2023?
2023 is a huge change year. There is something coming up in the pipeline. There's something that's already effective as of now. The biggest thing is anti-flipping rule. Anti-flipping rule is effective January 1st, 2023. If you own a particular residential property, again, under 365 days, and you sell it within 365 days after you purchase it, then the profit that you make are automatically deemed business income. Now, a lot of people would have the misunderstanding that when you purchase a property and when you resell that property, you either do not need to pay tax if you moved into the property, or you pay capital gain tax on it. When I talked about capital gain tax, it is 50% taxable. So people are under the misconception that it's either tax-free if you lived in it before, or it's only 50% taxable. So if you make $100,000, only $50,000 is being taxed, and you pay maybe $25,000 of tax. Now, but the reality is that there are certain rules that it has always been around. Those rules, those considerations CRA would look at to determine whether the sale of a property is considered capital in nature or business. If it is business, then 100% of the profit that you make is considered income. Whereas if it is capital in nature, then you would go into, hey, did you live in the property before, or are you using it as a long-term rental? Then the sale would then be considered capital in nature and 50% taxable. If you've lived in the property for the entire duration of ownership, then 100% of it would be likely tax exempt. So those are the original rule. Now, CLA since 2015, they've put a task force together. They put extra effort to audit people in the real estate sector in Ontario as well as in BC. They've since recovered over $1 billion in Ontario, $1 billion in BC as well. And a large number of audit is evolving around people flipping properties or claiming that they move into the property, and then claim primary residence exemption and not pay tax on the sale of the property. Meanwhile, they're really operating a flipping business. So they're trying to target those people. The way that they have always been targeting those people is by looking at transactions that happen 365 days or less within the purchase day. Now, those are low-hanging fruits because the consideration that they would go through is that how often do you do the trading? How long would you have owned the property for? The shorter the duration of ownership and the more frequently you purchase and sell the residential property, the more likely you are viewed by court that you are doing a business rather than doing a capital long-term investment transaction. And so they've always tried to target the low-hanging fruit, and the low-hanging fruit is under ownership duration under 365 days. But that's not enough. The government decided, hey, this is not enough. CRA want to make it even easier. Now they impose this rule under 365 days, for sure, all the profit is called business income unless you fall under one of the exemption. The exemption would be like someone joining your family, leaving your family, if you pass away, you get fired, or there is personal safety. There are a bunch of other exclusion to this.
All sound reasonable.
Yeah. Now, but then I'm giving you an example. If you move into a property, you own this particular property, and you really find that it's a lemon to work with, and you uncover a bunch of issues that you didn't know. But then someone walked in and say, hey, I am interested in buying your property for a profit. You're like, well, like I wanted to get rid of it as soon as possible. Your original intent is really to, buy it and then rent it out. Now all of a sudden someone come along within 365 days, you sell it to this person, then 100% of the profit that you make would be taxable. Now, another example is that if you were to purchase a property and you move into the property. Now, I don't know how you prove personal safety. Maybe it's not personal safety. Let's say you move into the property and you're like, well, my neighbor really stink, or my neighbor smokes a lot and I hate that smell and I need to sell this property because my neighbor smokes and I can't tolerate it. It's not quite personal safety. You don't have documentation to prove it. And it doesn't fall under any of the exclusion that unless you get fired or you are getting married, then all of a sudden, if you were to sell within 365 days, the profit that you make from the sale of the property would then be considered 100% taxable.
Ouch.
Regardless.
Bit of a fringe case, but yeah.
Yeah. So those would be the situation that could potentially get caught under this rule that would be legitimately for other reason, right?
I would have thought that a lot of pre-construction condo investors would be caught in the anti-flipping anything.
So that's another new rule that came out actually last year, May 7th, 2022. So they talk a little bit about pre-construction, not necessarily condo, pre-construction home. When this new anti-flipping rule also got introduced, they also clarified with the pre-construction condo assignment sale. For anyone who commit to purchase the pre-construction home and decide to sell that contract, so
Before
selling
closing,
within 365 days after you purchase the property, after you purchase you enter into the agreement of purchase and sale. Because when you enter into the agreement of purchase and sale to purchase a pre-construction home, it could take a couple of years or 6, 7, 8, 9 years before it materializes. But if you resell that contract within 365 days after you enter into the agreement of purchase and sale, then the profit that you make would then be considered 100% taxable. Majority of the clients would not be doing that.
Right.
Now, but then on the other hand, if you close the property, a brand new home, and within 365 days you sell it, because like with condos especially, you close the before you close the property, you already take possession of the property You're renting it essentially. So the moment that you close the property, you may want to sell it already. But the reality is it's been, if you sell it within 365 days and the transaction happened in 2023 onwards, then you're caught under the same rule as well.
And then what about assignment fees? Is there HST on that?
Yes. So I did a great YouTube video. I have to promote myself. I did a great
believe you're
YouTube.
plugging your YouTube.
I know. So I did
Real
a great
estate tax tips.
YouTube.com/real estate tax tips.
What can they search to find the HST exam on assignment?
They search Cherry Chen, and then it's there.
Okay.
It's assignment and HST and everything. So essentially, the rule came into play May 7th, 2022. What it means is that any assignment fees, assignment deal, assignment fees that you earned for transactions that close after May 7th, HST is applicable regardless of your intention. So HST will be then charged on the assignment fees. In the past, before May 7th, HST would be applicable if you are not using it as your original intent was not to use it as your primary residence. So it's fuzzy. Now, May 7th, 2022 onwards, all assignment fees would be applicable.
Right. No different than realtor commissions.
Yes.
All HST applicable.
Yeah. Mm-hmm.
So that sucks. I'm sure a lot of people who are holding pre-construction
on assignment fees only.
Yeah. Mm-hmm. But I imagine they're all not happy about that.
Well, before May 7th, CRA's position is that the deposit reimbursement by the buyer of your assignment deal would also be subject to HST. That was the position in the past. But May 7th and onward, they said, hey, like you already pay HST on the deposit, so therefore no HST on that amount. So they clarify their position, which is beneficial to people. It's just before it was confusing.
All right. Oh, what about anti-flipping? What if you're the anti-flipping rule? What if you're flipping within the using a corporation?
So if you flip your houses within a corporation and you're really conducting a flipping business, the profit that you make is 12.2% in Ontario. 100% of it is taxable, but you're only subject to small business tax.
Right. So the majority of my professional flipping clients, they're using corporations
to begin with. Yes.
To begin with, so nothing really changes for them.
Yeah, so that's why some in the accounting world, some people are arguing that, hey, like the rules have already been in place forever. It's just that now they just make it a slash, like a clear, draw something in the sand saying 365 days and less. For sure you're flipping. I don't care. But they are only targeting people who make a profit. If you have a loss, because last year's situation is a little different, the market is still not going back up yet. If you incur a loss and it is within 365 days, you cannot just call it a business loss. You still have to go through the original criteria. How often do you do the trade? If you are, do you have insider knowledge? What's your intention? They still look at the old criteria to make sure that you fall under the business, because capital loss is not as beneficial as business loss.
So it sounds like this any home flipper tax is beneficial for people who are buying to live, and it actually sounds beneficial to my professional flipping clients.
The business loss?
No, the fact that there'll likely be less competition for flips.
Oh, well, so it's really targeting people who are abusing the rule to begin with, right? So they claim that
they're probably amateurs as well if they're not flipping within a corporation.
Yeah.
They're not really in the business of it.
They're dabbling into it. Yes. Yeah. Yes, absolutely.
Okay, I have no problem with that. I think wow, that anti-flipping tax got a lot of hate in the community, but really it doesn't affect many.
It doesn't. Like a lot of our clients.
Not our community.
Yeah.
I know a lot of people out there do these things, like they'll flip whatever and claim they lived in it. Yeah, it's great for them, terrible for everyone else down the line.
Yeah, absolutely. And they're really trying to target those people.
Okay, I have no problem with that. All right. What else we got? This should be a Halloween show.
So there's the new trust reporting rule that is coming into play.
Okay, never heard of this one.
So this trust reporting rule, before you shut down this whole podcast, listen to me. It's coming down and it's applicable for this fiscal year 2023 calendar year. And the legislation was released December, and it was supposed to be effective last year. And obviously they didn't get it done. And I guess the UHT is already a huge headache for CRA. So they allow the postpone and delay for this trust rule. So this trust rule specifically call out bear trustee to file a T3 trust return.
Okay, what does that mean in plain English?
So in plain English, if the people that we identify that is acting as trustee, owning the property in trust for a corporation, you are on title owning, your corporation is owning a property in trust for you personally, because it happens a lot as well in the real estate investment world.
Yeah.
You own a property in trust for a joint venture relationship. That's a you don't call it a trust. It's not registered trust per se. It was bare trust arrangement. These bare trust arrangement now has to be reported by CRA to CRA.
Oh.
Starting next year. It's applicable this year.
So this is pretty common.
Yeah, so the same with the Underused Housing Tax Act. That the same trust relationship would have been identified by this new trust reporting rule, and we all have to report it.
So what should investors do where this applies?
So using our townhouse as an example, you are now owning it in trust for me because you're on title for mortgage and you're owning it in trust for me. Mm-hmm. So you would have to file a trust return as for next year and report that trust relationship, even though you have nothing to do with the property. You're really on title for mortgage purpose. So UHT is one, and then trust reporting is second. Now, what can investor do? Now, since you're still on title in our example, as of this moment, you're still on title, so you still have the reporting requirement. The trust reporting rule is applicable to any ownership that happened during the year. It's not as at December 31st, at least based on the current legislation. So essentially, there's nothing you can do. The only way that you can get away from it is for future years. So in the current year, you would try to get away from this trust relationship. Maybe in our particular example, we will try to remove your name from title. That's going to help eliminate the future filing obligation, but not for this current year. For 2023, you still have the filing obligation.
How realistic is that, though?
Huh?
Because I was at it for mortgage purposes.
Yep.
So how likelihood would I be removed?
I don't know. It's a conversation that you need to have with your bank, right? So this is one example. A lot of our clients have the properties owning in trust for the corporation that they own. It's often a get around because it's harder to get financing.
Right. Or just for a point of clarification, folks, if for the listeners' benefit, if you have no idea what we're talking about on this specific point, likely it doesn't affect you. If you know what we're talking about, this likely affects you.
Very true. So if you own the property in trust for the corporation, now this is applicable to any trust relationship, not just residential properties. We're talking about all properties now. So you purchase a property in trust for a corporation and your corporation report all the income and expenses, you're acting as a bare trustee, then you need to file that return.
Interesting. So it's a rich person problem. I'll generally just throw that out there. What is the objective of this reporting rule?
I guess there are a lot of people who are owning properties and they are not really reporting who the true owners are.
Oh, so the government just wants more visibility into who owns what.
Yes. Yes.
Getting more into our business.
Yes. They should know. And it's just that they now wanted to. If you had a family trust set up, you would already have been filing that family trust return on an annual basis. It's all these bare trustee agreement behind the scene that nobody knows, right?
Yeah, it seems like they keep asking for more information from us. Because I remember, I forget what year it was. I'm sure you remember when, because only a few years ago, the CRA asked how much we made when we sell our home. Correct? Mm-hmm. Yeah, mm-hmm. That was only a few years ago.
2017.
Oh, okay, longer than I remember. And so they just keep seeming to ask for more.
Yep.
Interesting.
That rule came into play because people are abusing the primary residence exemption.
The one I'm talking about, where
Yeah,
because
yeah.
the government wants to know how much we're making when we sell our home. So
They don't know how much you're making.
until we report it.
You only report the sale price. You don't
Oh, we
report
don't
the
report.
purchase price.
Okay.
Yeah.
They can look up land titles.
They do. They can. Yes, for sure. But they don't. If they are really trying to get that information, they could just ask for it. I'm surprised that they're not.
Yeah, I'm surprised they're not.
Yeah.
Interesting.
Certain situation they do. If you don't live in it and it's not your primary residence the entire time, then they may.
Okay. All right. We're running out of time on this Halloween special. I'm joking about Halloween special. It is February 19th as we're recording. Is there anything else that investors need to absolutely know for new tax changes in 2023?
I don't think there are many. There's like a couple of minor ones. I don't even know if you need to know. Like, it's not particularly for investor. For first-time home buyer, there's the introduction of the first-time home buyer saving account. It works kind of similar to like a RSP, a hybrid of RSP and TFSA. The contribution to the FHSA account is tax deductible, so similar to RSP. If you withdraw from the FHSA account for the purpose of buying your first home, then you would be able to withdraw it tax-free. So all the income that you get from it and the investment return, together with the withdrawal, would be tax-free, assuming you're withdrawing it for the purpose of buying your first home.
Sorry, money going in, is it a tax shelter?
Yeah, tax deductible. So like RSP contribution.
Oh, interesting.
But money coming out is not added to your income, assuming you use the money
to buy
your first home.
Is this something that parents could do for their kids? They can contribute
Absolutely.
To it?
So annual maximum contribution is about $8,000. Lifetime contribution is $40,000.
That's not very significant.
No, it isn't. But it is something that you could potentially take advantage of. So that's FHSA. They haven't really officially introduced it and allowed the institution or the trustee. When I say trustee, it's really the bank that holds these FHSA RSP account, the register account for you. They haven't allowed that to be open yet, but it will be sometime this year.
Like the lifetime amount, I don't even know if that covers the double land transfer tax in Toronto.
Yeah, exactly. But I'm just saying, it is available. Yay! It's new.
Justin Trudeau saving us all.
The first year is $8,000 only. So
thank you, Justin.
And then another thing is the multi-generational home tax credit. I think it's for renovation. If you're putting a suite in your house for your family member to live in, I think there is a multi-generational tax credit available. I think you can get back up to $7,500. You need to have receipts, and there's a criteria that you need to meet in terms of the suite setup. It needs to have its own kitchen, as well as bathroom, as well as a second place. Second
egress? Second exit?
Second exit, yeah.
Okay, so it sounds very much like our typical basement apartment strategy.
Yeah, but except that you do need someone to live in there for you with you to get the $7,500.
It has to be a family member.
I think so.
Okay. Can you remind us again how our tax credit works? Because it doesn't come off the top of your income. Where does it come off?
From the bottom.
So after all deductions, then
no. So it's calculated really based on the lowest marginal tax rate. It is a refundable amount though. So $7,500 is the maximum you can get from CRA, which covers us up to, I think, about $50,000 of renovation expense.
Okay, I'm trying to equate what $7,500 of tax credit gets me in a duplex conversion.
$50,000.
It probably pays for like my basement egress window.
Well, it is better than not having it, and plus, it's not meant for investment property per se, right? Like, it's for you to live with your elderly mom, or with your elderly aunt.
Fascinating. Thank you, Justin Trudeau, for saving us. If they could just, figure out some less red tape, that'd probably be a lot more effective than this.
Yeah.
All right, we're out of time. That's all the tolerance we have for this Halloween special. Again, I'm joking, folks. This is February 19th as we're recording. Cherry, thank you so much for doing this. I think we'll probably have to have you back in a few weeks if you can manage it during tax season to tell us whatever else we need to look out for.
Yeah, wish us luck. Wish all the accountants out there luck as well.
Yeah.
Accounting firm, public accounting firm.
And all the spouses of accountants.
Good luck, everyone.
Thank you for watching. If you want to learn how to invest in real estate from scratch, my team teaches beginners how to use the #1 investment strategy that I personally use in a virtual free training class every month. Go to investortraining.ca/YouTube to register for our next class. The link is also in the description as well. I publish at least 2 to 3 videos a week here, so subscribe if you want to keep learning from seasoned investors like myself and my guests. And if you're just starting out, feel free to ask questions and comment below, and I do the best to answer each of those comments and questions myself. Again, if you're ready to learn the nitty-gritty about real estate investing from a professional investor, register for our next virtual class. That's at investortraining.ca/YouTube. Thanks again for watching. See you in the next video.